So, good afternoon, friends. This special episode is basically to understand a tremendous change which has been brought out into the budget 2023, which has been just passed in the parliament by the government of India. This is going to play a major change into the taxation of the debt mutual funds. All the retail participants, all the retail investor, and the financial institutions who are parking their money with the debt mutual funds, right? They are going to be affected in a great way. Let us first understand before the budget why it was a very preferred vehicle for debt allocation. Because in certain debt products in the mutual funds like liquid funds, dynamic bond funds, yield funds, etc., when the horizon is more than 3 years, there is a certain taxation advantage. And that is why it was very beneficial for the investor to park their money into the debt mutual funds. Let us take an example. Say if I want to invest as a retail investor, say 25 lakhs in my debt allocation, I do not want to take any risk into the equity, then I will just try to invest into dynamic bond funds or liquid funds or short-term funds or certain kind of fund of funds where I have a lot of safety as compared to the stock market. If I choose to invest same money into the bank FDR, I might get 7%. Here also saying debt fund, I also get 7%. But in a bank FDR, that 7% interest will be taxable upfront from the day one. Here in the debt mutual funds before the budget, right? If I park the money into the growth scheme of this debt fund for more than 3 years, then I enjoying the lower rate of taxation by way of the long-term capital gain tax. And that is why my post-tax return on this instrument goes up. And that is why it was a very, very preferred route. But after this, lot of episode which has happened into the global market, especially the European banks, American banks, which went bust, and there was a crisis, and there are many more in the line as I can read into the Reuters and the Bloomberg news. The government might have sensed that there might be a need to protect the fixed deposits of the nationalized bank and private sector bank. So and that is only route, by way of blocking the money which is flowing from the bank to the mutual funds, debt funds. So what they have done, they have closed this taxation arbitrage. Now, from 1st April 2023, whatever the investments you make into the debt fund, right, whether it is for 1 year, 2 year, 3 year, or any time of the period, it will be taxed on a redemption at short-term capital gain tax. That means at my slab rate, I have to pay the tax. So as far as the rate of tax is concerned, there is no arbitrage between the fixed deposits and the debt funds. So obviously, there is no incentive left for the people to go towards the debt market mutual funds. So whenever you want to park a handsome money into the safe products, you really need to consult your financial advisor or your chartered accountant and take the call very, very judiciously. Otherwise, your tax burden can go up. Now, having said that, which are the funds, which fall under this category? They are like your liquid funds, ultra short-term funds, gilt funds, right? Fund of funds, your gold ETF, your silver ETF, your international feeder funds, your hybrid mutual funds where majority of the investments into the debt, these are more than 65% into the debt products and very little into the equity sides. And your monthly income scheme where majority of the investments into the debt side, very little on the equity side. These are the funds you are going to get a huge hit. So if you have existing investments, you are protected because any investment before 31st March is not touched. But any future investment after 31st March, it is from 1st April, definitely there is going to be a tax burden and you need to be very careful when you plan your investments. So having said that, what is left from the 1st April? Will you go for FDR? Then also you should know that in fixed deposits, the insurance for a PAN number is 5 lakhs in totality. So your capital is guaranteed or insured up to 5 lakhs only. So where people should park their money? That is a big question if they look for safety in their investments and the regular income. Now here, because of certain global turmoil in the financial market worldwide, the yield, that means the interest rate in the secondary market in some of the debentures and the bonds which are guaranteed by the government or a state government has gone up. Now, I sincerely request all of you to look at these options, consult your financial advisor, look at some investable grade opportunity where yields are high and you have a 100% capital guarantee by the state government or the central government as the case may be, and that you should look at and take a very conscious call before you invest your hard-earned money. Thank you very much.